Welcome back to the deep dive. Today, our mission is pretty laser focused. We are tackling the economic outlook for 2026.
Right.
And we're doing that by zeroing in on a critical set of sources analyzing China's economy. We're going to deep dive into 5 major predictions that, frankly, paint a much more conservative picture than you might be seeing in the headlines.
Yeah, and it's a really necessary analysis. I mean, for anyone watching global markets, 2025 was just, it felt like a year of extremes.
A real roller coaster.
It really was. You had policy stimulus that sort of stabilized things in the first half, but then by the second half, key indicators just took a sharp downward turn. A dramatic reversal that I think shocked a lot of analysts.
And that structural pain we've all been talking about, the property crisis, weak household consumption, the debt levels, it didn't just go away.
Not at all.
So now, as the country gets ready to launch its 15th five-year plan, we're starting with some serious headwinds. And here's the real tension for you, the listener. You've got this international consensus, places like the IMF, predicting GDP growth somewhere between 4.5 and 4.8%. But our sources, they're forecasting something much, much more cautious. And that difference, that 1%, that's billions in asset reallocation decisions.
And we really need to understand the data, the logic that underpins that cautious view. We're going to use logic and some very specific data points to break down why 2026 is facing this significant deep-seated downward pressure.
But what are the 5?
We're unpacking 5 key predictions. A meaningful GDP slowdown, a painful housing correction, then a sort of mandated policy-led investment rebound, persistent consumer weakness, and finally the accelerating physical contraction of the retail sector.
Okay, let's unpack this. Prediction 1. The GDP slowdown, mainstream agencies are hanging their hats on that higher number. What's the rationale there?
Well, the thinking from institutions like Goldman Sachs, the IMF, it's surprisingly traditional. They believe that strong net exports are going to act as this powerful external buffer.
So global demand will save the day.
That's the idea, that demand for manufactured goods will be enough to partially offset this slump we're seeing domestically. They see growth around 4.8%. Maybe the World Bank is a little softer, like 4.2 to 4.5.
That's the hope. But our source material is highly skeptical, forecasting a much lower 3.5 to 4.0% GDP growth for 2026. So what specific data from late 2025 is driving this pessimism?
It's the sheer velocity of the domestic slowdown.
Yeah.
I mean, we always talk about the 3-horse carriage of growth, right?
Yeah.
Consumption, investment, exports.
Yeah.
The 2 domestic horses just stalled.
Yeah.
Dramatically. Like fixed asset investment, FAI, that's all you're spending on infrastructure, factories, property.
Yeah.
FAI turned to negative growth for the full year 2025. This is critical. It's a total reversal from the positive momentum they had the year before.
A move from positive growth to actual negative investment is a massive economic shock.
Absolutely. And consumption did the same thing. It was growing at 5% in the first half, boosted by subsidies, but it just decelerated so rapidly month after month and then plummeted to just 1.3% year-on-year growth by November.
Wow.
So when your 2 biggest domestic engines are slowing that fast, just relying on exports, which, are subject to all sorts of global, political, and economic headwinds, it just doesn't stabilize the whole system.
It sounds like the analysis is that this isn't just some cyclical downturn they can print their way out of. If the government can't stop that kind of deterioration, what justifies the lower prediction?
It comes down to structural pain. And the fact that this pain isn't just, it's not going away overnight.
Yeah.
We're talking about population aging, which impacts labor and demand. Massive debt overhangs at every level, corporate, local government, household, and just historically low resident confidence. And that's tied directly to job security and, of course, housing wealth.
So these aren't temporary headwinds.
Exactly. They fundamentally constrain domestic activity, which justifies that stickiness in the sub-4% band for 2026.
That lack of confidence brings us right to prediction 2, the housing price correction. This is really the heart of the structural challenge.
It is.
We already saw big price adjustments in 2025. New home prices fell almost 4%, and used homes, especially in Tier 1 cities, saw drops of, 20 to 30% from their peaks?
And housing is where so much of the nation's wealth is stored. So this prediction it's deeply impactful. And while, mainstream analysts like Reuters and UBS are forecasting maybe a modest further drop, say 1 to 2.5%.
A soft landing?
Kind of. But our sources argue the necessary correction is far larger when you apply, rational, cold-blooded investment math, specifically the rent-to-yield ratio.
Okay, here we go. This is the crux of it. Walk us through the math. What are rational investors seeing that suggests the bottom is, well, nowhere near?
Okay, let's use this specific data point provided. Take a 5 million RMB apartment in Beijing. If you, the owner, rent that property out, your annual rent typically nets you somewhere between 72,000 and 84,000 RMB.
Okay, so what is that as a return, as a yield?
It's tiny. That means the property is only delivering an annual return, a yield of 1.5 to 2% on the asset's value.
1.5 to 2%. For an illiquid asset in a major global city,
Okay.
that's not a compelling number.
Not at all. Now compare that risk to the risk-free rate. If that owner sold the apartment for cash, that 5 million RMB is roughly 700,000 US dollars. If they just put that cash into a secure instrument, say a dollar deposit or something linked to a stable 10-year treasury rate, which is yielding around 4 to 4.17%, they would earn 24 to 28,000 US dollars annually.
So the illiquid, risky property yields maybe 2%, but the risk-free cash equivalent alternative gets you over 4%. The opportunity cost is massive. No rational capital stays in that investment.
The math just demands an adjustment. For the property yield to equal the risk-free rate, one of two completely unrealistic things has to happen. Either rents have to double rise 100%.
Which isn't going to happen.
No. Or the price of the apartment has to drop by roughly 50%.
50%, that's not a mild correction. That's a systemic reset of wealth perception for an entire generation.
Yeah.
I mean, is that even politically sustainable, even if the math demands it?
That is the impossible question for the policymakers. But because demand is so constrained by high inventory, weak incomes, slowed urbanization, a massive rent hike is just not realistic.
So prices have to fall.
The correction has to continue. The prediction for 2026 is an accelerating drop of another 10 to 20%. It'll hit the third and fourth tier cities and the used housing market the hardest, all driven by rational investors who are just watching, not buying.
That housing outlook is grim, which makes our next point, prediction 3, the most interesting twist in this whole forecast.
It is a bit counterintuitive.
Yeah. After detailing all that deterioration, we pivot to a predicted rebound in fixed asset investment, FAI. Help us understand that.
Well, the context of the FAI decline is what makes this so noteworthy. As we said, FAI was down 2.6% for most of 2025. Real estate investment alone was down nearly 16%. It really did look like the investment tax were turned off.
So if the market isn't going to pull itself out of this hole, what policy lever is powerful enough to swing that deeply negative trend into a positive 2 to 4% growth forecast?
This is a classic political cycle intervention. 2026 is the crucial startup year for the 15th five-year plan. And the central government views infrastructure and state-led investment as their most reliable, their most proven tool for guaranteeing a minimum level of GDP growth and, political stability.
So if the government hits this target, this 2 to 4% FAI, aren't they just admitting they can't engineer organic growth, that they're just kicking the can down the road on the necessary rebalancing? What does that do to economic efficiency?
That is the trade-off, absolutely. They're choosing stability through mandated investment over immediate market health. And we are already seeing the policy signals. The Central Economic Work Conference strongly emphasized stabilizing investment. Key provinces like Guangdong are mobilizing. The expectation is for a much more aggressive fiscal policy.
And what does that look like in practical terms?
It means expanded quotas for high-leverage tools, so special treasury bonds, local government bonds.
Right.
This capital won't flow into the struggling real estate market, but into manufacturing upgrades and, crucially, infrastructure projects. This policy move is what's expected to swing FAI from negative into that positive 2 to 4% range. It's a buffer, it's a policy floor, but it's entirely government mandated, not market-driven at all.
Which brings us neatly to the consumption side of the ledger with prediction 4, the massive consumer crunch. We noted earlier that consumption just fell off a cliff, especially after the policy help faded.
Yeah, it was an incredible data cliff, and it really highlights just how hard it is to engineer sustainable demand. Retail sales peaked back in May 2025 at 6.4% year-on-year growth.
That was because of the subsidies, right? The trade-in progress.
Exactly. They were designed to spur big-ticket purchases. But the moment that stimulus expired, the numbers just dropped off dramatically.
So just to trace that decline again, the average for the first half of the year was 5%. but the monthly rates just plunged down and down to only 1.3% by November, and that 1.3 was also a month-over-month decline.
And you really felt this collapse in durable goods, things tied to the property market, appliances, cars, furniture. People just aren't buying the things to fill the houses they aren't buying. So the key question for 2026 is why this slump is expected to continue.
What's the primary diagnosis? Is it just slow income growth or something deeper?
It's a few compounding factors. You have persistently slow income growth, relentless unemployment pressure, bleak economic expectations, and critically, the fact that the 2025 subsidies just buried a ramp. They borrowed future demand.
Ah, so that consumption was pulled forward from 2026 and 2027.
That's it. That demand is gone now. The market is basically running on fumes, and it lacks that genuine new household demand.
So what's the prediction for sales growth then?
The worry is that overall retail sales growth will drop even further, settling in a really tough 1% to 2% range. I mean, online retail might do okay, but the weakness in physical commerce will just dominate.
And that feeds on itself.
It does. It feeds that classic vicious cycle our source identifies.
Yeah.
Weak consumption means weak corporate profits, which leads to weak employment, which means weak household income, which further weakens consumption. It's a self-reinforcing downward spiral.
And that vicious cycle manifests in a very visible, very dramatic way in our final point. Prediction 5. The accelerated physical store closures. We are literally seeing the economy contract in the retail landscape, and it's hitting big international brands.
This is the brutal, tangible reality of sustained weak demand. Over 17,000 physical stores, supermarkets, apparel, restaurants, everything closed in just the first half of 2025. And this isn't just mom and pop shops. This is a structural failure of the old retail model.
I think the most visible example of this has to be IKEA China. I mean, they're strategically retreating from their massive big box format. Starting in February 2026, they are shutting down 7 large outlets. We are talking about Shanghai Baoshan, Guangzhou Panyu, Tianjin Zongbei, Nantong, Zuzhou, Ningbo, and Harbin. They are shifting decisively to a small format, online-focused presence.
Yeah, when an international retail giant like that makes that level of strategic retreat, shutting 7 major stores at once, that is a huge signal. And we see it with others too. Manning's is shutting down all of its mainland stores.
So why do our sources predict this is going to get even worse in 2026?
The combination is just disastrous for physical retail. You have weak final demand, you have relentless e-commerce competition, and you have high fixed costs like rent and labor. So the prediction is that closures could exceed 20,000 stores in 2026.
20,000.
The entire physical retail sector is being forced into survival mode, which is accelerating this shift towards smaller, more localized, community-focused models. That level of contraction tells you exactly how deep the pessimism in consumer sentiment really is.
Okay, let's quickly recap the 5 key predictions we've unpacked for 2026. We're looking at weakened GDP, predicted between 3.5 and 4.0%. Housing prices are facing another major correction of 10 to 20%, which is really demanded by that rent-to-yield math.
Right.
Then policy will lead a government-driven fixed asset investment rebound of 2 to 4%. But that policy buffer won't cure consumer demand, which will stay structurally weak, growing only 1 to 2%. And finally, we expect accelerating retail closures, potentially exceeding 20,000 stores.
The overarching theme is that the structural challenges are just dominant. 2026 will be a challenging year, and that policy response, specifically in investment, is really the key mitigating factor that prevents an even deeper contraction.
So what does this all mean for you as you process this data? Here is the final thought to mull over. If the government successfully uses its policy levers to engineer that FAI rebound of, say, 2 to 4% prediction 3, but consumption remains stuck at 1 to 2% growth prediction 4, what are the long-term structural implications?
It's a great question. Because the government has repeatedly said it needs to rebalance the economy away from reliance on investment and toward consumption. If their primary response to economic pain is to double down on the old investment model, how sustainable is the entire system?
Right.
Can you indefinitely prop up an economy on state spending while the real engine, domestic household demand, just sputters? That's the question of the structural trajectory for the entire decade ahead.
A difficult path forward. Thank you for joining us for this deep dive. We'll catch you next time.